What's up, Confident Real Estate family? I'm your host, JC, and on today's video, we're going to delve into some of your questions. Specifically, we're going to delve into a question from Michael, who tells us that he is interested in buying a property with a good longtime friend of his. They're going to do a joint venture, and he wonders, do they need to have separate LLC set up for the purchase? Should they come into the purchase of this property with separate mortgages for their each for their own half of the purchase price? And do they need any written documents between each other, between themselves, or should they do it on a handshake because it may be insulting to ask for a written agreement with a close longtime friend? It's a lot to dissect, so let's delve into it. First, let's delve into the issues of whether or not you need an LLC. Now, he doesn't specify whether he's buying a residential or commercial property, but I'm going to go out on a limb and assume he's buying either a single-family residence or a duplex or triplex, some kind of multifamily residential property. Now, typically, you're not going to qualify for a residential mortgage unless you're taking that mortgage and the deed to the property in your own individual capacity, meaning in your name versus the name of an LLC. Banks want to see you personally on the deed and on the guarantee for the loan. If you're taking a commercial mortgage, then it's more often than not that you're going to acquire the property under an LLC. Now, if you were going to acquire, let's say this is a commercial property and you're acquiring it under an LLC, you would typically have one LLC that you set up specifically for the purposes of buying this property as a special purpose entity, as they call it. And that special purpose entity would be owned by you and your joint venture partner, either in your own names or under separate LLCs that are an extra level of liability protection for each of you individually. And then the cash flow from the property would go through the ownership entity, LLC, into your individual entities, let's say it's 50-50 here, and then to you personally as ultimately the beneficial owners of the property. Now, if you're going to go that route, you're going to have an operating agreement for that ownership LLC, and the members of that LLC would be your individual LLCs, or you as individual people. But if you're buying the property together as individuals because it's a residential property and you're getting a residential mortgage, then more often than not, you're probably going to buy it as tenants in common based on the amount of money each of you is contributing to the purchase. So let's say, to make the numbers easy, that you're buying it 50-50. Each of you is putting up the same amount of money. Well, then you're going to probably buy it as tenants in common. That means each of you is going to buy the property owning 50% of the property. Nobody's going to own 100% of the property. Now, this varies jurisdiction to jurisdiction. You always want to seek legal counsel locally for wherever you're buying the property. But typically, you would be buying as tenants in common, and you would enter into what's called a tenancy in common agreement that dictates the term of the relationship between each of you as the separate tenants who are going to own the property 50-50 for the purposes of this example. And that way, you have something written between you. Don't ever think that it is an insult to ask somebody you're entering into a business arrangement with to enter into a written agreement. There are courts across the United States of America and the world that are filled with people who didn't think it was necessarily important to get a written agreement with their business partner. Now, when it comes to the mortgage, there's going to be one mortgage. You're not each going to come to the table with a mortgage for your 50% share of the purchase price, because mortgage holders can only be in lien position in a sequential order. Meaning, if you get a loan from a bank, that loan becomes a lien on the property, and that's what the mortgage is. And they will be in the first lien position. If there is a second mortgage on the property, they will be in a subordinated lien position, meaning they will be behind the lender who is in the first lien position. So if there ever becomes a default and a need for a foreclosure because everything goes south, well then in that situation, it's an unfortunate situation, only the first lien position mortgage holder will be able to go forward with the foreclosure and collect the majority of the money from the foreclosure sale. If there's anything left, then the second person in line, the second lender in line in that subordinated lien position will have the ability to make a claim for whatever scraps are left. If the sale of the property of foreclosure doesn't even make the first mortgage holder whole because the property sold for significantly less, then the second lien position holder, that second mortgage lender, is not going to see a dime, and they can still come after you in most jurisdictions personally. So for those purposes, you will have one mortgage that you will both need to qualify for. You will both be the borrowers jointly, and you will both be the guarantors jointly. As they say, jointly and severally. Even though you only own half the property, you will be responsible for 100% of the money. So choose your partners wisely, and once again, this goes back to the importance of having a written agreement with whoever you're doing the investment with as your joint venture investment partner. Whether it's an LLC operating agreement or a tenancy in common agreement because you're buying the property together as individuals. Always put it in writing. The other benefit of all this is once you have the agreement in writing and you guys have put in the legwork to see it through, if the deal goes well and it proves fruitful and profitable, then you have everything in place to just repeat the process. Either with another tenancy in common agreement for the next property you buy individually, or another operating agreement. You just use the same one, change the name, change the property address, change the lender information, and you're back in business immediately. The first time around is where you put in the legwork. After that, you've got a process in place that you can easily repeat. So that's the benefit of all this. I hope you got a lot out of it. Michael, I hope that answered your question. I know I emailed you most of this already, but I'm glad we were able to share it with the rest of you. Please don't forget to hit the like button down below so that you feed the YouTube algorithm and this video gets circulated to many other people who may also find this information useful. Please also hit subscribe so you don't miss our future content and videos that we post on a weekly basis. Again, thanks for stopping by Confident Real Estate, and we hope to see you next time.